Welcome to the Pirls Stock Market Commentary video for September 11th, 2016. Market breadth. With this past week's market decline, our bull-bear point and figure ratio fell to 1.61 from 1.72 last week, continuing in bullish territory. The total count of securities in bullish or bearish patterns decreased 2% to 3,124. The count of bearish stocks increased 3%, while the count of stocks in bullish patterns decreased 4%. The Pirls P&F Market Breadth Summary Chart shows us a market now 11 consecutive weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly Pirls Stock Market Commentary via email free of charge, simply enter your email address in the space provided. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 7 points for the 11th decline in 30 weeks. At a positive 482.14 points, it continues below the recently formed August 2016 top, the April 2016 top, and continues above all remaining three tops above plus 100, and it continues above all six bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in distribution mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 1 accumulation day and 3 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode on lower average daily volume. Momentum, now fallen to a minus 269.54 from a positive 110.1 a week ago. With only 1 day below zero, the CCI 20 daily continues outside the plus or minus 50 range required for a valid zero-line reject entry signal. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 19 weeks ago, while the daily CCI 20 began a Woody's uptrend 8 weeks ago. The CCI 20 weekly fell to a positive 78.29 from a positive 110.80 last week, after forming a zero-line reject long entry signal for Monday 7-11 open. Because the CCI 20 weekly has fallen below plus 100, we exit the trade at Monday 9-12 open. We will report the results of this trade simulation in next week's commentary. Industry rotation, the last 2 weeks. 4 of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: banks, brokers, and some tech on top. Some tech, retail, and oil services on the bottom. Bullish, computer hardware, and KBW Bank continue in the top 5. Oil services continues in the bottom 5. Bearish, S&P retail continues in the bottom 5. Semis and disk drives have entered the bottom 5. Gold and silver has left the bottom 5. Focus this week from www.zerohedge.com. Deutsche Bank, the U.S. may now be in a recession. The following are some key points. 3 months ago, we presented an analysis which showed something disturbing. According to Deutsche, the current business cycle is already the 4th longest in the post-World War II period. and the corporate debt to GDP ratio suggests that imbalances are building, and that worse, as a result of soaring corporate debt and rolling over profit margins, a recession could hit as soon as the second half. Overnight, and 3 months since its last such analysis, Deutsche Bank has published an update. It shows that, as illustrated in the chart below, profits per worker have generally trended higher over time. This is a function of productivity gains and inflation. However, this has changed in recent years. In the current business cycle, margins peaked at $18,752 per worker in Q4 2014. This compares to a ratio of $16,487 per worker as of Q2 2016. Margins have fallen because corporate profits have declined minus 6.3% annualized over the past 6 quarters, while private sector job growth over this period has been very steady at around 2.1%. And before we get the usual but you must exclude energy complaints, we wonder why it is becoming increasingly obvious that oil is not going back to $100. So the new norm oil may well be crude at $50 or lower, which means including all energy-related data. Here is the punchline. It's excluded. The reason margins are a leading indicator is simple. When corporate profitability declines, a pullback in spending and hiring eventually ensues. As illustrated in the chart below, the ratio of non-financial corporate debt to nominal GDP is at its highest level since Q1 2009, when the economy was still in recession and nominal output was substantially depressed. Alongside tepid demand, the weakness in corporate balance sheets means that the Fed needs to be alert to any possible tightening in financial conditions for one reason. Based on nominal corporate balance sheets, the U.S. is already effectively in a recession. The only thing preventing the hammer from falling are recorded low interest rates, keeping interest coverage ratios at all-time lows. The current business cycle is already the 4th longest in post-World War II period, and as we mentioned before, productivity growth has been abysmal. Hence, there is little cushion for the economy to absorb any negative endogenous shock. And worse, as the chart above shows, with corporate debt to GDP ratio at recession highs, it suggests that imbalances have built up to the point where there is absolutely no capacity for tighter financial conditions. Summarizing all of the above, based on corporate balance sheets and income statements, the U.S. economy may be in a recession as of this moment. And if it isn't, even just one rate hike by the Fed, either in September 21st meeting or in December, will assure that the backbone of corporate America, already straining under record debt and tumbling profits, will finally snap. Thank you for viewing this week's Santu Pirls Stock Market Commentary, featuring the proprietary bull-bear point and figure market breadth summary chart, compiled by Donald Pirl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.